What's up, ladies and gentlemen? Welcome to another video on our YouTube channel. Today we will be going through the move from the past week on EURUSD from Monday up until Friday, and we'll be using the weekly expansion range method. Now, without wasting any further time, let's get into the chart. Starting off on the daily time frame, we saw three important factors which ultimately assisted us to accurately determine our setup. The first thing we determined was where the market came from, which is having traded through these relatively equal lows over here, which was our liquidity pools. Sell side liquidity. After the market traded through the relatively equal lows, it then traded into this order block over here and reversed from it. Now the market changed its direction, and we can determine this by seeing this market structure shift over here. The way that we see a market structure shift is if the market created a high, right, and then it created a high, then created this low over here, came back to break this particular high, then this is regarded as a market structure shift, because this is a low, it came to break this particular low and then came back to break this high over here. This is a market structure shift. It created a low, created a high, came back to break this low, and then came back to break this particular high, right? So from here we had to determine where the market is likely to trade to, which was our liquidity pools. Now we had this high over here, which we determined it was our first liquidity pool, buy side liquidity. Then we had this high over here, our second liquidity pool, and we had these relatively equal highs over here, right? Now from here we can go to the 4-hour time frame, right? So after the market had created this market structure shift, the market left behind this fair value gap, over here, which it came to trade into, with this move, right? And then after trading into this fair value gap, it bought and it broke this short-term high. It broke this short-term high. It then left this order block over here that we anticipated that the market would trade into in order for it to buy, right? This order block. So the market came back and traded into this order block. So we had anticipated that the market would buy up until this level, or that level, but the market simply decided to consolidate for about a week or so, right? It had consolidated, and it then came back to break this high, which we can say is a minor break of structure, right? After breaking this high, we then anticipated that the market will simply buy to this level and to this level, right? Going to the 1-hour time frame, we could, some might say that this is a bit confusing. How can we determine that the market would buy from where it bought? It's simply because it was trading inside this breaker block over here. It was originally an order block, but it wasn't really an order block because the market hadn't broken this low yet. But because the market broke this high, this became a breaker block, which is annotated, became our breaker block, right? So on Monday the market was trading inside this breaker block, right? And we do not trade on Monday, so we just set and try to see what will happen in the market. So on Tuesday the market came to break the short-term high that was created on Monday, and then came to trade into this order block. Now, it traded into this order block during the Asian session, which meant that we were not taking any trades during the Asian session, because we did not trade during the Asian session. So we just waited, and we waited for continuation patterns or models during the London and New York sessions, right? So during the London session, the market came and break the high that was created on Tuesday, and it also left behind this fair value gap over here, right? During the New York session, as a matter of fact, when the New York session opened, the market traded into that particular fair value gap, right? So that is where we had taken our first entries over here, and we targeted this particular high, our liquidity pools, the ones that we have determined, right? And we placed our stop loss 20 pips below, which gave us a risk to reward ratio of about 3%, of 1 to 3, right? And then on Thursday, remember, seeing this can be referred to as an order block too. So on Thursday, the market opened and traded into this order block, which is where we took our second trades for the week, our order block, which is where we took our second trades for the week, and our target was this high over here, the liquidity pool, and we still have some trades running targeting those two relatively equal highs, right? So yeah, that is it, ladies and gentlemen. So currently the market is trading inside this fair value gap. Now it might buy from here and to hit our liquidity pool, but this is not a signal of some sort. It is just my observation. Now, with all that being said, ladies and gentlemen, this is all for today. See you in the next video. Now, if you have any views or any questions, please comment down below, and if you like the video and hope to get new ones, please like and subscribe. Now, see you in the next video. Cheers.